What's going on, everyone? This is Rob from Rob Invest coming at you with another video. Today, we're going to talk about margin investing. We're going to talk about the good, the bad, and the ugly. So, let's get started. Let's warn you, hell, I'm going to warn you guys, okay? You guys seen this in my video, but I am not a financial advisor. This video is for entertainment and educational purposes, and please do your own due diligence. All right, so let's get to it. What is margin? Margin is when you borrow money from your brokerage account to buy more securities without using your own cash. So these securities can include ETFs, individual stocks, bonds, commodities, etc. Margin is considered leverage. Margin is also considered a double-edged sword because it can help you, but it can also hurt you. In other words, this can magnify your gains, and it can also magnify your losses. All right, in order to understand the basics of margin, you need to understand some basic terms. So the first term is initial margin. Initial margin is the amount of money an investor needs to put up in order to buy additional shares. So for an example, most brokerages are going to require a 50% margin maintenance. So for an example, if you have $10,000 in securities, then the brokerage account is going to say, all right, well, since you have $10,000 in equities, we're going to lend you up to $10,000 in our money so you can buy additional shares. Margin maintenance. Margin maintenance is the minimum amount of total equity. Your total equity is your borrowed money plus your own equities that you need before you get into a margin call. So margin maintenance is based on percentages. It's going to depend on your brokerage account, but a lot of them have 25, 50, 75, 100%. The higher the margin maintenance, the newer or the riskier the stock may be. And if a stock is risky, then the brokerage account is going to tell you, okay, you can only borrow less money. But if you have a 25% margin maintenance, let's say like the SPY, then they're going to say, okay, well, you can buy more. We're going to give you an additional money because the stock or the ETF is not at risk. So for an example, if your total equity is $20,000 and you invest in a stock or ETF that pays a 25% margin maintenance, what you do is take 20,000 times 0.25, and that's going to give you 5,000. So basically, your margin maintenance is $5,000. So what your brokerage account is going to tell you, okay, you have to be at $5,000 and you cannot go below that. Now, if you go below $5,000, if your equities drop below $5,000, we're going to issue a margin call. All right, more margin terms. Buying power. Buying power is the total amount of money you can purchase equities or securities with borrowed money. For an example, if you have $10,000 of equities, they're going to give you $10,000 of borrowing power, which is going to give you a total buying power of $20,000. So that's that. And margin call. When your securities or equities fall below margin maintenance, and your brokerage account will contact you to deposit funds. And they do this so you can meet margin requirements. If you fail to do so, they have every right to sell your shares. right, so this is an example of magnifying gains and magnifying losses examples. So let's say we have 10,000 worth of XYZ, and we borrow an extra $10,000 worth of stock XYZ. So we bought $20,000 of XYZ. So let's look at the bullish cases, in the case of being bullish or the stock market going up. So if the stock market goes up by 10%, you actually gain 20% because of the extra money that you borrowed. You're not going to use the $20,000 because it's not your money. So you're going to go off this $10,000. On the other hand, this is where it can hurt you. If stock XYZ goes down 10%, you're going to lose 20%. So your 10K investment is going to go down to 8K investment. It's going to go down to 8K. Remember, the extra $10,000 is not ours. So we have to go off the equity. So we benefit from the profit, but we still have to take the extra losses. But that's just, like I said, it's a double-edged sword. All right, so let's dive into margin call. So if you get a margin call, what's going to happen? Your brokerage is going to contact you because your equity fell below your margin maintenance. It happens when your equities fall. It could be in a recession. It could just be like you just investing in the individual stock, and it's just basically your equities have gone down too low. So when when a brokerage account contacts you, they're going to tell you, hey, you got 24 to 48 hours to deposit this money. And if you don't, we're going to sell your shares. Now, if you deposit that money, however that much they need, then you're good. They're not going to harass you anymore. And you're back to the margin maintenance. So again, failure to do so, the broker will sell your shares to meet the margin maintenance requirement. Now, I don't know if they sell all of your shares. I don't know if they take a partial out. I don't know. I've never been in a margin call, thank God. But if you guys are watching this video and you guys have been in a margin call, just let me know. Put it in the comment section. So, for an example, if your margin maintenance is $5,000, right? You have to maintain $5,000 worth of securities. And your total equities dropped to $4,000. Now you're going to get a margin call. So now it's 5,000 minus 4,000. That is 1,000. So now you have to put $1,000 of cash before you get a margin call. Because if you don't, they're going to contact you. They're going to send you an email. They're going to say, hey, you need to put $1,000 in. If you don't, we're going to sell your shares. Okay, so we're almost wrapping it up here. Word of caution when using margin. Do not speculate. So what I mean by not speculating, do not speculate. Do not listen to other people. Like, do not buy a stock because it sounds cool. Do not buy a stock because you think it's going to go up 100% a month. Don't buy a stock because you heard your friend tell you that this biotech stock is going to go up 1,000% a year. Don't even believe what a lot of the analysts say, because the market is going to do what it wants. And if you're wrong, you're going to pay for it. If you're not careful with margin investing, you can lose all of your money. And sometimes you can be at a negative sometimes. Especially if you maxed out your margin on a extremely, like let's say a biotech stock. Let's say you put all that borrowed money into a biotech stock and that just goes down. Let's say they have a bad earnings report and they go down 50%, now your 50% is gone down to 100%. So that's what I meant about the magnifying gains and magnifying losses. And if you cannot stomach that, I mean, you're going to be in trouble. Monitor the market on a regular basis. Now, if you're in a bull market, I wouldn't really worry about it. But if you are in a downtrending market, such as a bear market or a recession, or if you have individual stocks that are not performing well, then you might need to monitor it, because there's a good chance you might be in a margin call. Buy low maintenance margin equities. What I mean by low margin maintenance equities, I'm talking about anything, let's say 30% and under. That's just my opinion. So some good ETFs or stocks is QQQ, which is 25%, SPY 25%, Coca-Cola 25%, even cover call ETFs like SPIY or QQQI, which is also 25%. Have cash on the side, because again, the market is going to do what it wants to do, right? You're gonna have a bear market, you're gonna have a flash crash, you're going to have a recession. So when those things happen, there's an increased chance that you're going to get a margin call. So even if you do get a margin call, you have some cash on the side. So even if your broker calls you and say, okay, well, you need X amount within 48 hours, you'll be able to put that cash back into that account, so you don't get harassed. The last one is, do not max out your margin. I look at margin as like credit utilization. Now, for a credit card, you shouldn't use no more than 30%. Anywhere from 10 to 30% is a good range to use. In my opinion, if you're doing more than that, then you're setting yourself up for failure. And it also depends on what types of ETFs that you buy, what type of stocks that you buy, how risky they are. I would even say, if you're buying stocks or ETFs that have low margin maintenance, I mean, you can even utilize 50%. But if you're using higher risk stocks, like let's say MicroStrategies, you might only want to use 5% of your margin, because MicroStrategy has very wild swings, and that's a high chance of you getting a margin call. All right, I think that's it. Oh, one more. Why do I do this? I do have a little bit of higher risk tolerance, and I want to make as much gains as possible. The reason why I use margin is because I'm investing in cover call ETFs. Now, I like doing it this way because my cover call ETFs, some of them pay me on a weekly basis and some pay me on a monthly basis. And these distributions help pays down the margin. This will increase my monthly and weekly income, and I can buy more stock. If we get a recession or whatnot, I can use that cash that I don't have, to buy beat down stocks, because I know it's going to go up in the future. Alright guys, that's all I have for you. If you guys found this video helpful and informative, please like, share, and subscribe. If you guys have a margin account or doing margin trading, put it in the comment section. If you guys found this video helpful, just put a thumbs up. If you guys have any questions about margin, please put it in the comment section. Alright guys, I will see you in the next video. Peace.